Hello, Jay. Hello, Terry. How are you guys doing today?
I'm good, Sherry. How are you?
Good, Sherry.
Good. This week, we have the biggest event in the whole universe, which is Nvidia earnings, and would like to discuss with you guys and also about the PCE data it's going to release tomorrow. So looking at Nvidia earnings, they have beat both the revenue and focus strong Q3. And the company also announced 50 billion share purchase. But when we are looking at the chart, after hours, stock price has been down. And just want to hear you guys from the fundamental perspective and technical perspective. What's your first response to that?
Yeah, I'll take a look. I'll take this first here, Terry, if that's cool with you.
Absolutely.
So you provided a preview for Nvidia on the paid site there, and we went into depth into some of the issues that Nvidia bulls were going to be facing this time around. Perhaps one of the biggest issues is the ability to blow out expectations has kind of diminished, and a big reason for that is simply from the fact that analysts have a better idea of how to forecast for them. If you recall, back in May of 2023, Nvidia shocked the markets by throwing out a revenue forecast of $11 billion. Now, at the time, analysts' expectations were for about $6.5 billion. And obviously, the key driver for them was the AI chips that, people were kind of starting to get their head around how much, AI things. And that was the first time you really got a glimpse of how big of a deal this could be for the markets. That led to huge tech rally throughout the summer of 2023, primarily driven by that data set. And then Nvidia not only met those numbers, but they went on to proceed to really blow out the expectations around them. However, each quarter, what we've been seeing is those blowout beats getting a little bit less and a little bit less. And that's exactly what we saw happen this time around. I mean, revenue came in at 30 billion, which is 122% year over year, which is just pretty much unfathomable for a company this size. But it just kind of goes to show the growth there. Now, 30 billion was the whisper number. The consensus number was 28.8 billion. But Nvidia, as we've seen, they need to really blow out figures rather than just simply beat. They did beat, but just not by a less amount than what people have gotten used to. Earnings per share, pretty much the same story. We saw them come in at 67 cents per share, or about 16.6 billion in total income. Huge, but FactSet consensus, that stood at about 65 cents. So it was only about a 3-cent beat on that front. And again, that's just not as big as what people have become accustomed to. The other area that we saw this factor in was, of course, guidance, where Nvidia provided guidance that was above expectations. However, just the beat compared to number was once again a little bit lower than what people had hoped to see. Now, we had outlined this dynamic going into the report, and it certainly came into fruition. Now, key drivers for Nvidia, data center remained the key. That's, of course, where AI was. That soared 154% year over year, and even 16% sequentially to come in at 26.3 billion. So big numbers there that continued to come in. Other areas, gaming revenue, it was up 16% year over quarter, outpacing expectations, but failing to impress as much as that had in the past. The professional visualization area, that was up 20% year over year and 6% quarter over quarter, thanks to a ramp up in their RTX GPU. Another good number, but again, just kind of slightly beating. And then automotive, you did see a nice bounce back in the automotive sector, as that was up 37% year over year, but only up about 5% quarter over quarter. Their AI cockpit solutions and self-driving platforms, obviously the key drivers there. But again, nice bounce back in auto, but this is a small part of their business. Now, the other thing that we had highlighted in the preview was concerns around the Blackwell chip, which is their next generation chip. It's supposed to cut drastically down on energy usage, which is really the new holy grail for these chip makers, given how much the expense of the pop of. And so a lot of concerns around Blackwell and GPU interface, that they were running issues with that just simply wasn't running as effectively as been promised. And this, again, Blackwell is supposed to take over their Hopper chip. The Hopper chip continued to see strong demands. We're seeing plenty of companies that are more than happy to continue to grab the Hopper chip, not so worried about the upgrade to the next Blackwell chip. Now, with regard to the Blackwell chip, the company had some upbeat comments around it. Jensen Huang was talking about it and noting that demand was very strong for it, that they're expecting it to see it start making an impact in Q4, and that any of the delays that people were worried about wasn't really going to slow down things too much. Now, you could take a look at the guidance and say that perhaps they are a little concerned by providing a little bit more conservative guidance, but they did try to do that in the call. So all total, everything was just humming on all cylinders for Nvidia. I mean, just growth for a company this breathtaking. But again, the beats weren't as big as they've been in the past. The company had been trading at about 33 times forward earnings, so pretty expensive here. The free cash flow came in at $13 billion. Again, another huge number there. They are returning some of that to investors with $50 billion share buyback that they announced. That should help with the valuation concerns there as they do a little financial engineering. But all total, and we'll get into some of the options plays here in a second, but I'll let Terry take over and talk about some of the chart action going on there. All total, this was a great quarter by any means. It just simply wasn't an Nvidia quarter, if you will. And therefore, you saw a little bit of profit taking following the news. But, I don't think that there's anything here that people from attempting to buy dips if it gets to favorable levels. And that's what we discussed in the preview. But Terry, I'd be curious to your interpretation of some of the chart action that we've seen out there for Nvidia.
Yeah, sure. Thanks, Jay. Now, I think one of the points Jay makes is super important, which is when he talks about the analysts just getting a better handle on how to gauge the growth that they're seeing here, that sort of caught with their pants down, thing exploded into a kind of exponential gear. And I would say that you can see the same on the chart. So it's not just the analysts, it's the market in its ability to discount what you've been seeing in the past. You get the blowout quarter, and then you get the amazingly positive price reaction. Part of that is that catch-up process. And we have a sort of almost parabolic chart when you pan out to like the weekly chart. And that's that adjustment. People saying, growth rate here is much, much expected. And this is a company that's it's right dead in a structural growth theme. Structural growth theme, there's not going to be, it's not Crocs bad. And you got this momentum theme in terms of earnings where suddenly you're going to have that one wrong note quarter and the whole thing's going to collapse, because they're going to be sitting on what is, very much a centralized kind of macro. It's not anywhere. AI is not going anywhere. It's going to be for the next decade and beyond. And they're a central player in that theme. So there's that lack of risk. So people are willing to take more shots. But the market has clearly kind of caught up growth rate that it's going to be tougher to get those big positive price reactions. And we're going to kind of swivel around that doubt point each quarter. But I think it's still a situation where, given the growth theme, this is, if you get a big dip, people are going to pile in to take advantage of it. And there's competition for that. And so when you look at the chart, you see this competitive framework around getting access to dips. So the dips aren't as deep. And you'd like to see a situation, if you're looking to get involved in this, you'd like to see it puke out those 110s. And it only got down to 116, and it's already starting to come back. And it's just tough to get involved because people have so much about the long-term picture for this company. But we really, it had been for most of that exponential 80, which is just really rare, except for some, really weird momentum stock stories that you see up from time to time. But a company this big, that's already a mega cap company, to live in that sort of 80 plus RSI zone is really rare. We're still right back at 50. It wasn't even overbought coming into this report. But there was a lot of hemming in it, and across the entire market. And I think one of the things that you're seeing today across the entire market is basically, you see how important this story is to everything. You can tell this was not a bad quarter. because everything just got past that uncertainty point and the hedges started coming out of everything else. People were hedging futures, rest of the tech sector, NQs, everything across the board into Nvidia's report and taking it as almost a macro data point. And it passed that data point. So the rest of the market's taken off. Those hedges are coming out. And we're back to the sort of the Fed story. But yeah, you see, if you want to get off of the stock, you really would like to see something, you know, a little more of the fast money.
So just one other aspect to this that we pointed out in the preview, I would note options activity that's factoring in. Nvidia is 20% of the single stock options on the markets. That's just incredible amount. And busiest area for Nvidia was the 130 calls.
Yes.
Now, if we 137 level, a lot of those calls are going to just expire pretty much worthless, certainly below the 130 area. And that's a dynamic that's also getting factored in here, where you have perhaps some people panicking a little bit and selling their calls because they don't see it getting up to that level. You can see on the chart, 130 has just been a roadblock there. So the inability for Nvidia to spike up and get those calls into the money is also going to weigh in on the shares. I mean, a lot of these will be expiring tomorrow for weeklies. So, you know, that's another element here that probably allows you to be a little bit more patient and, you know, see if this, you know, they back up through that 25 area. They weren't able to do it. And it's going to be very difficult for them to push it up at this point, which means you're going to have more and more of those 130 calls just expiring worthless and people just throwing in the towel and selling them, which will put some downward pressure on and could get it down towards that 110 level that Terry was talking about. So, you know, we preached patience in the preview, be the key. So just kind of let some of these dynamics play out. And they're certainly factoring in to the response that we're seeing in the market here.
Got it. And when we are looking at the 30 minutes time frame chart, it seems that the stock has been going sideways and the traders has eyeing 130. It hasn't been seems break out that long time resistance. So and I think maybe next we would talk about the expectation of tomorrow's PCE data. And here is a list of like what other data dropped before Fed's meeting in. So would you guys expect the PCE data given like the previous job data? I think there's initial jobless GDP data this morning, and it looks pretty good.
Yeah, I can start off on this one. Go ahead and tell me if you think I'm right or wrong. But I would say this is, I think there's just a chance that they have the last important, highly anticipated inflation data point for this year. I think that we've got a very clear trend. Now, one of the data points the Fed looks at, the market's going to react to those data points, is the 6-month annualized core PCE. That's kind of the window where they see that as being where there's enough sample size to really show them the context they're in. If you're looking at, you know, the trailing 12 months, that's the one that's number that is in the press up front, but it's not really what the Fed looks at. The Fed looks at if you analyze and 6 months ago we had a sort of aberrant data point with a 0.5% month core PCE really sticks out, and that's going to drop out of the data set this time. And the consensus expectation range for tomorrow morning is 0.1% to 0.2%, kind of in that. If we get 0.1% or unrounded on 0.15, you're going to see the headlines basically be that something core PCE is dropping from 2.8% to 2.1%. And that is going to nail short-term rates to the floor. That's going to be kind of the big flag sticking in the ground saying mission inflation. And it's really no longer a story, even in any way. And that's really going to allow the Fed to act that way. So even though this really is sort of a negative black swan potential kind of data set from here forward, you know, what if, you know, sudden reemergence of inflation and it catches everybody off. There's that story's there as a possibility, but it's probability possibility. But there's also tomorrow morning the possibility that we're going to see the Fed's primary window on this shift to a qualitatively different zone that really basically says, risks are no longer balanced upside and downside. It's 100% just on making sure we keep the unemployment rate from leaping up 5%. What do you think, Jay?
Yeah, no, I mean, you're hitting the nail right on the head. I would even argue that the last important inflation already passed, potentially, right? We know that the Fed's been shifting more towards growth last couple of sessions. Obviously, they want to see, as Terry said, the nail in the coffin on inflation. And there is for that, given some of the dynamics that he pointed out. One of the things I would point out, certainly the most important one for the Fed, but it's also, it's a July number, right? So PI, we've gotten the Manheim Index, we've gotten New York Empire, Philly Fed, all University of Michigan sentiment, all these July data points that usually foretell what PCE is going to look for. There's how they come to the numbers for PCE versus CPI in terms of how much they're looking at shelter and vice versa. But I don't expect to see much of a surprise from PCE, and it's more at this point of do we go 25 or 50 basis points, and I'm expecting PCE to kind of go past without have a ripple on them. I think that much bigger number is going to be that data point next week, especially since we're coming out from a period where the BLS just downgraded the amount of jobs that were created in that March 2023 to 2024 timeframe by 818,000. So I think that people are a lot more in tuned into there. And what we just really need from PCE is to kind of go through, come in line or even slightly above. And I think they'll do more than anything is just help tune people towards a 25 or 50 basis point cut. But I still see jobs next week is really the big number for the people. And, that's going to be walking a thin line. You want to see that number a little bit light, but not light enough that those recession worries creep up. So PCE will certainly be of interest. But I think more than anything, just let's get past this headline and hope that it's not too all signs point towards that being the case. So if we do see that come through, we're going to get through two more big tech headlines tonight. Who's the other one? And Marvell tonight. And if we get through without anything else, we should continue to see a drift higher going in through the markets tomorrow into the 3-day weekend. And then all attention is going to be turning to those jobs numbers next week.
Yeah, it makes sense. One thing I would counter with is if we see it come in under tomorrow, backward looking data point, but it's still the context for the Fed. If we see it come in, at the 2.1% trailing annualized 6-month core, and we see big, amazing jobs number, I think that could be the ultimate best case scenario for the market because you've still got a Fed that's 200 basis points above neutral. And maybe they need to cut to save the jobs market, but they're still going to be cutting. They're still going to be cutting in a strong economy without an inflation worry. Like that's kind of an amazing situation that you almost never see.
In between 25 or 50, right? Not whether they.
Yeah, no, I think they're going to be 50 after the election, 25 before.
I think that's the most likely scenario. Because we got September 17th, and then the next meeting is the day after the election, right?
Yeah.
So
they can just,
and the Fed always says that they don't like to, but also don't want to, rock the boat too much either, right? So
don't want anybody any excuse to think they are being political,
right?
Even if they want to do it, if they can make it till November, which they would be able to. Presumably, we're not going to see a terrible jobs report. I mean, if we terrible jobs report, then that that goes window. But if we see anything in line, they can wait. So they probably will choose to wait to avoid giving any kind of ammunition to anybody who wants to make the case that that's being political.
I'd agree.
Yeah. So to wrap up here, my last question would be, as you guys previously mentioned, August and September had the seasonality, and I think the investors should invest when we're heading into September, or we wait after September. And if we in September, which index would you guys think has the most potential, like from DIA, QQQ, SPY, and IWM?
And go first. I mean, I'm still kind of on the road. We see take off after the election. I think it's so do that from here. Especially we've got a mixed market. Got some things that have been outperformed, and it's in a different gear for a month. Consolidating. If we have a technology sector that's kind of in this year, and if we've got the seasonal weakness, especially the point cut till after the election itself is a point of uncertainty. Doesn't really matter which side wins. Generally speaking, the market doesn't do much right in front of an election, and it does a lot afterwards, especially if it's in a bull market. You usually see that pause, and then it takes off. It really doesn't matter who the winner is. Historically, you cannot case it by which party wins. The outcome is usually just about the same. The uncertainty being removed is the catalyst. So, and I think that if we are in a situation where we kind of, that short end of the curve being pinned to the floor favors IWM, especially if we've got some of these mega caps in a consolidation phase.
Yeah, I mean, the way I look at it is, might continue to drift higher going into the, and that cut turns into a bit of a sell the news reaction. The September cut, correct.
Yeah.
That jobs number, again, large. You don't want it negative. I think right now the consensus is around 155. Just something in that range. A little bit lower is fine, a little higher is fine. Would be that would allow for a drift higher, waiting for the cut. Then you'd see a bit of a rollover in the cut. That seasonality coming into play, and bleeding into October. That first part of the earnings, starting to talk about how's Q3 earnings looking right now. That gets factored in, but I wouldn't be looking at a massive drawdown at all or anything like that going into the election. As Terry was saying, a little bit more of a sideways chop with a downward, kind of how I'd look at it. Now, you want to, until we start seeing some sort of data that's recessionary, I don't think you want to be timing the market too much on that. So, maybe taking a little bit off the table would be if you're trying to time it and jump in and out of the market around these events. Because like Terry was saying, I think more of a sideways chop with a little bit of a downward edge just because of the run up going into the rate cut more than anything is probably how things will play out. But, again, the data has been steady. There hasn't been any that red flag. Certainly keeping an eye out on the credit issues, but again, haven't seen any red flags from there. So I think that you want to be careful and trying to be too cute and trying to guess tops and bottoms, and more or less trimming a little bit would be helpful going into that seasonally weak period. But overall, I don't think you want to try to get market too much.
Yeah.
And one final point. So we're coming into this period again, seasonally the toughest period to slow through until we get to second half. Or 3/4 of the way through October, generally speaking. And we've got sentiment data that's really kind of a little bit outside of comfort zone in terms of AAII bull ratio, well above the red line at 68. We've got 2 consecutive weeks on AAII above 50% bulls. We have the option speculation index way above the red line. We've got Lobo ratio, the large large open put call ratio. So way more calls than puts. There's not a lot of hedging. There's plenty of speculation that's in the market. And usually that doesn't mean the market has to tank or anything like that. Just during a seasonally weak period when people are already redlining some of these things, it's going to be tougher to just get that rip, that sustainable rip. But we could definitely leak higher into that.
Yeah, now we have a clear vision about driving into September. Yeah, got a lot of insights from you guys today. Thank you so much for your time, and we'll keep an eye on your release about the key earnings of Dell and Marvel today after hours. And look forward to talk to you guys next week.
Okay. All right. Thanks, guys.
Good. Everybody have a good one.
Yes.
Take care.